Hey, everybody. One of the biggest mistakes investors often make that I see is also one of the biggest potential opportunities, and it's buying stocks while they're going down. So, we're going to talk about two stocks in particular that seem to just keep falling and take a look and see whether they are bargain investments, whether they're traps to be avoided, and what investors need to know, because obviously stocks that keep declining and declining are not for investors without a high level of risk tolerance. Tyler Crowe is joining me to talk about one. He is Mr. Value Investor over here. I'm a value investor at heart, so we're going to get into these in just a second. Before we do, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It is the best way to support this work we're doing on YouTube. Again, fool.com/Frankel, and I'll put that in the description of this video as well. So the big one that stood out to me when Tyler suggested this idea is a company called SiriusXM. They are the satellite radio leader. Um, Tyler, I know you live on the other side of the world. Do they have Sirius over there? It's
I have not seen Sirius as of late, but caveat, I haven't owned a car that's more than 15 years old in the past 20 years.
That's fair enough. So yeah, in the U.S., Sirius is generally pre-installed on new cars for the most part. You at least get like a 6 month trial when you buy a new car. That's kind of their main business model is to put the product in new cars, get drivers loving the product over the first like 6 months of driving, and then they want to continue their subscription. And it's worked pretty well. They have a pretty large subscriber base, over 30 million or so right now. So it's a pretty successful model, but the stock is down significantly. It's down about 70% from its all-time high. It lost 57% in 2024 alone, and that was during a year when the stock market was generally performing really well. I want to say the S&P was up roughly 20% last year, so this one fell significantly. And to be fair, there are some good reasons why. Not only was Sirius's revenue pretty flat for the past 3 full years in a row, but we've seen it really start to decline. Um, Sirius's revenue was down about 5% year over year recently, and the subscriber base actually peaked in 2019, right before the COVID pandemic, and it remains significantly below where it was then. Um, and the recent numbers don't really paint an encouraging picture. Revenue was down by 4% year over year in the first quarter. Sirius lost over 300,000 subscribers. This was expected, um, but earnings per share declined, adjusted EBITDA declined. It's not looking too great. But don't make the mistake of thinking that management's not doing anything about it. They're really attacking the problem from two sides, one on the product side and one on the financial efficiency side. So on the efficiency side, it's pretty straightforward. Sirius is in starting year three of a 3 year cost reduction plan, and they are on target to see about $200 million of annual cost savings just by efficiency improvements in the business, their marketing strategies, things like that. On the product side, Sirius is rolling out a few different initiatives that so far are paying off. Um, One is I mentioned that you get like a 6 month trial subscription when you buy a new car for the most part. They're rolling out a dealer included option that's a 3 year paid subscription that's just included in the price of the vehicle. So instead of a 6 month trial subscription, and then you try to get people to subscribe, they pay $200 or so, and they have a 3 year subscription. So that is a tactic they're using to boost subscribers, and so far it's looking good. It's a pretty new initiative. They just actually launched their service in a couple of big brands. Tesla and Rivian just launched SiriusXM service in their vehicles in December. So that's not really reflected in the numbers yet. They've rolled out a free ad supported version, which has been a successful strategy for a lot of streaming companies. They just started doing that in a few different types of vehicle models to test it. They're doubling down on content, investing in some of the popular podcasts. One big worry with Sirius is that their flagship uh, program, the Howard Stern Show, is going to go away after this year. His contract runs out at the end of this year. He is in his 70s now, so there's a fair chance that he's going to retire this year. So that's a big thing that they're trying to kind of anticipate and plan for. But all in all, Sirius thinks it can ultimately grow its subscriber base to the highest level ever, surpassing that 2019 peak, and that it can grow its free cash flow by about 30% by 2027. And this is a profitable company. When I say grow cash flow, SiriusXM is highly profitable. Their 2025 guidance calls for about one and a quarter, oh, not one and a quarter, 1.15 billion in free cash flow, which it's rough. That's it trades for roughly 8 times free cash flow right now. So if it can achieve those goals, and that's a big if, I will acknowledge that if it can achieve those goals, it's conceivable this could be a very nice performer. But it's an turnarounds are an uphill battle, and this is a company that is still very much in the early part of its turnaround efforts. Tyler, what are you looking at?
Well, it's apt that we talk about one that's way down today because both of these stocks are way down today, specifically today. That's Enphase Energy and Solar Edge Technologies. They're both kind of the same business. Well, some slight differences, but both of them are in the residential solar industry, where they make a lot of the components that translate solar power into something you can use for your house, whether that be what's called an inverter, which turns AC DC power from the panel to AC for your house, whether that be some of the smart monitoring software that's used to, like, hey, should we recharge the battery, should we deliver the power to the house, or we should sell it to the grid, and the software that determines that. And they've also been bundling things like battery storage packs for a lot of their offerings as well. So kind of like the not the panels themselves, but a lot of the ancillary products that make a residential solar installation actually work. And it has been an absolute confluence of factors over the past few years that have made it incredibly challenging for Solar Edge and Enphase. Let's start with a slowdown in housing starting in 2022, 2023. The, a lot of one of the most frequent times that people put a solar installation on their house is when they buy a new house, because you get the new loan, maybe you're moving from one house to the other, you got that equity, you can use it to put in a solar installation. That has slowed down a lot. Higher interest rates means that financing costs are way up, which means that we're seeing slower sales from it being a little bit more challenging to make the numbers work in a higher interest rate environment. And then on top of that, there's been some regulatory changes. Both of them are very concentrated in California, and there were some changings to things called net metering rules, which is basically like when you create power for the grid and sell it to them, the rate at which you can sell that depends on what you're using the house. If you have a battery pack, you get to sell at retail rates. If you don't have a battery pack in your house, you get to sell it at wholesale. And so a lot of people who were, planning on putting installations started like pulling back, realizing like it's going to get more expensive with that battery pack installed as well. So, all of this has been big problems. As we speak today, both stocks are way down because some of the initial language in the tax and spending bill would remove a lot of clean energy credits. So that could be another headwind that these companies are all facing. But all in all, this has been like a 2-3 year thing where these businesses have been able to kind of right size themselves a little bit. Enphase in particular has been quite good at this because they rely almost entirely on third-party contract manufacturing versus having their own manufacturing facilities. And so they've been much better at being able to kind of scale up and down the amount of products products that they need at any given moment, been able to keep, lower working capital, less inventory. Seller Edge has been hit particularly hard because they've been having really hard times managing their inventory, which up until recently looked like it was starting to improve. And part of the reason I was looking at these recently is both of them started to show signs of growth again, growth in Europe, growth in the United States, both places starting to, on a year over year and even quarter over quarter basis, we're starting to see improvement. After multiple years of declines, this is a very encouraging sign. And so as a result, I think there might be some value here. This new tax credit thing that like dropped hours before we tape this might change that equation ever so slightly. So I'm going to go back and look again. But at the current prices, at the current levels of profitability, these are businesses I think that can or are still going to be able to do well over the long term. And I, but even though the stocks are way, way down, I think there might actually be a buying opportunity here and maybe not necessarily a time to be running scared.
I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.